If you're a self-employed individual, did you know that you could potentially contribute over $70,000 to a retirement account in 2025? That's what we're going to talk about in this session, all about the solo 401k. This can be a super powerful tax savings plan that can allow you to make higher contributions in comparison to an IRA and be able to self-direct into the investments that you deem as a good fit for your portfolio, like real estate, private equity, cryptocurrency, and much more. Let's jump in. If you haven't already, make sure to subscribe to our YouTube channel and hit the bell icon so we can alert you to all of our upcoming content. I'm John Bowens, Director of Education and Investor Success here at Equity Trust. We're going to talk about what is a solo 401k, how does it work? We'll talk about some of the eligibility requirements, of course, some of the intrinsic benefits of the solo 401k, and of course, break it down for you in a hypothetical example of how you can consider making contributions to a solo 401k. All right, first, what is a solo 401k? Well, think of it just like a 401k with a company you work for, but it's for you as a self-employed individual. Now, when we say self-employed individual, that doesn't mean that you have to have an LLC or an S corporation. All too often, I've had individuals that come to me and they say, well, I want to open a solo 401k, but I first have to go form this LLC or this S corp or this corporation. That may not be necessary. Now, maybe you talk to your CPA, your tax accountant, your attorney, and they advise you to form an S corporation or an LLC, taxes an S corporation, or just an LLC, and that's okay. The underlying requirement here is that you have earned income. So as a business owner, as a self-employed individual, you have earned income. When we say earned income, think income that you're paying Medicare and Social Security tax on. So for those of you that are sole proprietors, that's going to be self-employment earnings. Or maybe you're an S corporation and you're paying yourself a W-2. Okay, that's the earned income that's going to support the contributions to the solo 401k. So let's break down eligibility. So there's really two primary eligibility requirements that you need to understand in order to establish and fund a solo 401k. Number one, you cannot have any W-2 employees with the exception of you and a spouse. Now, I didn't do note that I mentioned spouse there. So there's an opportunity to be able to have a solo 401k for you as a self-employed person, hire your spouse, and then they can also be a participant of the solo 401k. But if you have W-2 employees that meet the eligibility requirements, then unfortunately a solo 401k is not going to work for you, and you're going to have to look at a different type of retirement plan. Maybe a SEP IRA, maybe a simple IRA, or maybe a multi-participant 401k. The second eligibility requirement we talked about in terms of having a solo 401k, and that is that you have earned income. Unfortunately, I've seen individuals be misled in this industry to think that they could have a solo 401k when they don't have any earned income at all. That's not the case. In fact, if you go to the IRS website, irs.gov, it actually states that your contributions to the solo 401k have to be recurring and substantial. And if you don't have any earned income, you can't make any contributions, which means you are not eligible to establish a solo 401k. Okay, let's break down how much you can contribute to a solo 401k. Now, I'm going to speak in terms of the 2025 contribution limits. If you're watching this video in 2026 or beyond, just go directly to the IRS website, irs.gov, to look up what the annual contribution limits are to a 401k for you as a self-employed person. In 2025, if you are under the age of 50, you can contribute the maximum of $70,000. If you're 50 and over, there's what's called a catch-up contribution. And that catch-up contribution is going to get you to $77,500. And then you will learn, because of the Secure Act 2.0, starting in 2025, if you're between the age of 60 to 63, that catch-up contribution that I spoke of, that you get when you're 50 and over, if you're 60 to 63, it's actually $11,250. So folks, if you're between 60 to 63, if you're structured the right way, if you're paying yourself enough earned income, that's $70,000 plus $11,250. That's $81,250 that you can contribute to the solo 401k. But folks, I'm going to show you in a moment how you can actually have all of those funds in a Roth component of the solo 401k. And that leads us to breaking down how much you can contribute based on the different buckets. So as you can see here on your screen, there are 3 buckets that we're talking about. So when you make contributions to the solo 401k from your earned income, remember, it's all driven by your earned income. That is your income that you're paying Medicare and Social Security tax on, if you will. For those of you that are self-employed, oftentimes we call that self-employment tax, all right? So when you're contributing, you have these 3 buckets. Now let's focus on the top bucket first, Roth bucket. You have an employee contribution. Your employee contribution, we haven't gotten to employer contribution yet. Employee contribution is $23,500 when you're under the age of 50 for tax year 2025. When you're 50 and over, you see there $31,000. And then if you're between 60 to 63, you get that $11,250 catch-up contribution. We then go to the employer contribution. The employer contribution is going to be based on a calculation applied to your earned income. So in the example that I'm showing you here, we have an individual with an S corporation paying themselves a W-2 of $100,000. Now, did it have to be $100,000? No, it could have been potentially less than that. But the illustration is showing you how to maximize the contributions. If you're not paying yourself enough, then you can't maximize the contribution. And if you're not paying yourself enough, you might want to have a conversation with your CPA or tax professional about, is there a way for you to be able to pay yourself more in order to make higher contributions? So back to the employer contribution, you'll notice there, $100,000 W-2 multiplied by 25%. For those of you that are sole proprietors and you're paying taxes as a self-employed individual, you're going to use 20%. For the purposes of this example, we're using 25% because we have an S Corp with a W-2. 25% times 100,000 is 25,000. Now you'll notice that 25,000 goes to the pre-tax bucket. So with a solo 401k, you have a Roth bucket and then you have a pre-tax bucket. Think of it like a traditional IRA, 2 different buckets. Your employer contribution goes into that pre-tax bucket. So your business is going to get a tax deduction for it. It has to go into that bucket first. But then you'll notice that you can do what's called an in-plan conversion. Remember that term, in-plan conversion. So you take that $25,000 and you convert it to the Roth bucket. So now we have the $23,500 and we have the $25,000. But it doesn't stop there. Now, if you don't have the plan set up the right way, and we can, of course, assist you with setting up the plan the right way, but if you don't have the plan set up the right way, then what's going to happen is you're going to be limited to just the employee and employer contribution that I just spoke of. But then we move on to bucket number 3. Some of you may have heard of this concept called a mega backdoor contribution. This is exactly what I'm talking about. The mega backdoor contribution. This allows you to get that full amount into the solo 401k every year. So you notice there the calculation. I take the difference of $70,000 minus my employee and employer contribution that I made, which gets me to $21,500. And that goes into what we call a post-tax contribution bucket. So the $21,500 goes into that bucket. Now here's what you need to understand. If we leave that money in that bucket, which is after-tax money, the growth will eventually be taxable. Well, we don't want the growth to be taxable, right? So what we're going to do is we're going to do an in-plan conversion over into the Roth component. So now you'll see as we aggregate all of that money, we get the full $70,000 into the Roth component of that solo 401k. So imagine doing that in 2025 and then 2026, let's say you do another $70,000. Now you have $140,000 in the Roth component of the solo 401k. You can use that money to invest in real estate, private equity, cryptocurrency, stocks, bonds, mutual funds, various other types of public and private market investments. And all of your growth is going to be tax-free. And when you distribute money from that Roth bucket, eventually in your retirement years at 59 and a half and beyond, you pay 0% tax. You leave it to your children or grandchildren and they pay 0% tax. So as you can see, this solo 401k with a Roth component, with this Roth bucket, is really powerful. And the 3 buckets displays for you exactly how you make those contributions and eventually do your in-plan conversion all up into that Roth bucket. Now, I know some of you are saying, well, wait a second, John. I don't want the money after tax. I want a tax deduction now. Well, that's okay. If you want a tax deduction now, maybe some of your contributions go into pre-tax and you get a deduction, and then some go into the after-tax contribution. Last but not least, I'll also mention that in addition to contributions to the solo 401k, you can also roll over money from other retirement plans. So let's talk about that for just a moment. You can roll over money from a traditional IRA, a previous employer 401k. You can roll over money from a SEP IRA or simple IRA. You'll notice the only retirement account that you cannot roll into the solo 401k is a Roth IRA. Unfortunately, the current law in 2025 does not allow you to roll over a Roth IRA into the 401k, into the solo 401k. If you have a Roth 401k with a previous employer, you can roll that into the solo 401k. Lastly, let me mention with respect to employees. So let's say you have a solo 401k and you eventually hire W-2 employees. Well, at that point, you're going to want to work with your tax accountant or CPA because you might need to transition that solo 401k into a multi-participant 401k. Also, be aware that if you have a self-employed business, but then you're also an owner of another business with W-2 employees, those 2 businesses might be considered in what's called a controlled group. And if you're in a controlled group, you might not be eligible for the solo 401k. So that gets a little bit more nuanced. We'd encourage you to talk to your CPA or tax professional with respect to, are you or are you not in a controlled group? And then that will determine whether you can establish and fund the solo 401k. So in conclusion, the solo 401k is a very powerful retirement plan for self-employed persons. Until the next video, continue to focus on compounding interest in the absence of taxation. Thanks for watching. If you enjoyed this video, don't forget to hit the subscribe button right here so you never miss out on new content. And if you're ready to dive deeper, check out our other videos and resources right here.